thank you all for being here today. I'm honored to be with Jim Brandenburg, who is in our Milwaukee office. I'm in our Indianapolis office.
Morning.
Morning, Jim. So a few housekeeping items, not unlike for those of you who have attended in the past, not unlike some of the things we talked about before. We have some poll questions throughout the webinar for CPE credit tracking. So please answer those questions so you can get your CPE credit for those of you who need that. If you have questions, please post those in the chat. You should find the question feature in your control panel. If we can't address the question, we'll follow up with you after the webinar. We did get several questions prior to the webinar, and we tried to integrate some of those into the actual content. So hopefully we can cover some of that as we go along. The presentation slides can be downloaded from the handout section of the control panel. We will record the webinar, and it will be sent out for on-demand access after the session. And then lastly, at the conclusion, there will be a short survey, and we'd like for you to complete that. For those of you who need CPE credit, please complete that survey. So I think that's it. So if we don't have anything else, let's jump right into it. We've got the disclaimer, introduced Jim and myself already. So what's on our agenda today? We'll give you a little background on the One Big Beautiful Bill that was signed into law. And then we want to talk about what to do now. What's it mean to us? So we've got this broken down by individual provisions, business provisions, charitable and exempt organization provisions, some international tax provisions, and then really some key takeaways from the bill. And as we said earlier, for those of you who may not have been on, there's a lot yet to be decided. There's a lot of guidance to come out yet. So there's some specifics that we can't really touch on today because we just don't have all the information. With that, I'm going to turn it over to my colleague, Jim Brandenburg, and we'll jump right into it. Jimmy?
Thank you, Tom, and good morning, everyone. Thank you for joining us here. As Tom mentioned, it was a big bill, a big, beautiful one that was just enacted here. And we thought we'd give a brief background because I think that kind of lays the framework as we go through this legislation here. This bill that was just signed into law, really, you have to look back to the Tax Cuts and Jobs Act. Many recall that in the first Trump administration back December of 2017. It was a major tax legislation, probably one of the most significant ones at the time, $1.5 trillion of tax cuts for businesses and individuals, really across the board. Many changes, however, especially with the individuals, were not permanent. They are set to expire at the end of this year, at the end of 2025, and they would go back to the laws before that TCJA. Significant tax hikes loomed in 2026 without any legislation. In fact, I think about a year ago, Tom, we did that in, I think, August of last year, kind of laying the groundwork for what was coming here. Next slide here with it. But what happened following the 2024 elections, Republicans did take control of not only the White House, but Congress, and then moved forward with the leadership, looked at wanting to deal with these TCJA items that were expiring and use the similar, what they call reconciliation process, which is a long, arduous process that Congress goes through. There was a lot of debate going on this whole first half of the year and drama, but the tax bill eventually moved through Congress. It passed Congress on July 3rd and is actually signed into law, the president, on the 4th of July. But again, there's some significant changes we're going to go through, as Tom mentioned, for individuals and businesses, some foreign exempt organizations. Again, this will be selected items. We're not necessarily going to go through everything, but there's a lot in there. First thing we're going to look at, as Tom mentioned too, we've broken it down, is some of the individual provisions. And the first part will be items that were set to expire. These TCJA ones are set to expire. And a lot of those ones, what they did was to make them permanent. And I'll just mention this, that we'll talk about that throughout the session today. Is permanent is not nothing's really ever permanent, I guess, with Congress, that they could always change it or new administration could change it, but there's no scheduled date for it. So it's going to be, the law will be changed and go forward indefinitely unless Congress at some point in the future would change it, but there's no scheduled sunset date with it. The first one is the tax rates. Again, there was that cut back in 2017 to 18 that provided a cut, and those rates will continue on again permanently at the end of this year. So we'll have the 7 brackets that we've got. Those will continue on. The standard deduction, which was doubled before, that will remain at a doubled rate. In fact, they did tweak it a little bit and add $1,500 to it. So it's going to be for a married couple, $31,500 for the 2025 year. And then the child credit, there was a lot of discussion with this. That had been raised from $1,000 to $2,000 by the TCJA. Now it's going to be $2,200. And again, that was made current with it. And there is a phase out with that, $400,000 for a married couple. So again, those are 3 significant ones that affect a lot of taxpayers: the tax rates, the standard deduction, and the child credit, again, made permanent with it. We have a planning tip here. We'll talk about it later about, in some cases, bunching your deductions with that standard deduction. And we do have an example on that coming up here. A couple other ones that were some of these TCJA ones that were made permanent. There is a limit on mortgage interest that came in that's $750,000 for a mortgage. That was made permanent. So just be mindful of that. And that $750,000 is not indexed for inflation. So again, as home values go up here with it, that limitation may start applying more and more. Any mortgage insurance premiums will be treated as mortgage interest, so just be aware of that. And if you do have any home equity loans, be mindful that that's only deductible if it's for home improvements that you have. Miscellaneous itemized deductions, again, we're limited by TCJA. That continues, so those won't be available. There is an exception, though, for certain educator expenses will continue to be allowed. And then the last one is any wagering losses. Again, used to be able to get those to offset your income, but now the losses are limited to 90% of your income with it. So just be aware of that for any gambling or wagering losses.
Hey, Jimmy, on the educator, just real quick. I mean,
Yes.
the one big change there is it's what they've had in the past had a cap on it, but now it's the amount of educator expenses is a itemized deduction, and there's no limit on it if you itemize.
Okay.
And frankly, they've expanded the definition of what that includes to actually some expenses of coaches. So take a look at that for those that might be affected by that.
Good. Thank you. Another one of these TCJA items that was dealt with in the bill here was probably one of the items that probably got the most attention this first half of the year. Actually, it's been a topic of discussion going back actually when TCJA was enacted. There was a state and local tax, the SALT, as it's referred to, that was limited to $10,000 from TCJA. Again, that was a sort of political hot potato in Congress. Some states that had higher income tax and property tax wanted that limit raised. Some other states didn't, or other members of Congress didn't want that. And it went back and forth in Congress. What they finally came up with is to increase that $10,000 to $40,000. Single filer will also get that. So there will be a slight marriage penalty with it. Anyway, it's $40,000. And again, that applies for the 2025 year. And then it's going to be indexed for inflation, go up at next few years. But then in 2030, it's going to come back to $10,000. So there'll be some more drama play out in Congress as they look either to have that continued at a $40,000 level or it'll drop back to $10,000. In addition, what they put in, there's they call it a phase down, is even though you have the $40,000 available, once the income for your adjusted gross income is over $500,000, that deduction is going to get reduced down to the $10,000. So it goes from 40 down to 10 on your SALT limit. Once you're over $600,000, you get a flat $10,000. So For those up to $500,000, they get $40,000. Then you have this phase down in there. So just be mindful of that. Again, that's for the 2025 year. Another thing that got a lot of attention just moved through and just wanted to make sure you're aware of it. A lot of states have put in, when they put this $10,000 limit going back to 2018, almost every state that has an income tax put in what they call a pass-through entity workaround, where they were able to have the entity pay that state income tax and not be subject to the SALT limit. That was put in, and there were going to be some proposals to change that, modify, not let businesses or individuals take this workaround. All those were taken out, so there's no changes with any pass-through entities. So if you do have any pass-through businesses and you're worried that you're going to get limited with this deduction, none of that was included in the final bill, so just be aware of that. And again, the higher $40,000 applies, again, for the 2025 year through 2029, and then it's going to drop back. Next one, this is a little complicated, if you will, but just wanted to make you aware of it. We used to have some deductions before the TCJA on some of your itemized deductions. It was referred to as the P's limitation. As for actually a member of Congress that came up with it. That was taken out by the TCJA. Well, this OB3 here came up with a new limitation for some of your itemized deductions. And again, it applies to those in the top 37% bracket. And basically, it takes 2/37ths, and again, of either your total deductions or those that are in the top rate. So essentially, what this does is if you're in that top 37% bracket and you have itemized deductions, you're only going to get a 35% benefit for those, not the 37% benefit. So just be aware of that. That starts actually in 2026. So that's going to be those in the top tax bracket are going to have a little haircut on their itemized deductions. If they do have some of those deductions, one point we put down is you may want to try to accelerate those into 2025 before this limitation takes effect. Another one that is going around here just a little bit, just want to make you aware of, it's called excess business loss. This came about with the TCJA, and it put a limitation in for a married couple. It's $500,000 that if you have a loss, that business loss that's above that, that loss is disallowed. It's not allowed currently, and it would carry forward to future years. This has been made permanent with the bill here, so just be aware of that. One thing to note is if you do have a business loss that exceeds this annual loss, that carries over as a net operating loss, which, not to get into the detail, but that's a more favorable way to use that excess loss in future years. So if you are subject to this in a year, it does become a net operating loss, a little easier to use up in the succeeding years. They did reset the limit. It's indexed for inflation. It had gone up to, I think, over $600,000. It's going to come back to $500,000 and then be indexed for inflation. So something to be aware of if you do have some business losses that are significant and how this new excess business loss account applies. Next slide. A couple things here just to note. One of the things that, again, used to be a big item for a lot of our taxpayers and also for practitioners was the AMT in the TCJA. It increased that exemption amount and also the point where it gets phased out. A couple things to note with it is that they reset the phase out. It's at $1 million now. And one of the things that they did is to change that phase out percentage from 25 to 50%. So we might see a few more, we have an observation there, might see a few more individuals subject to AMT with just the change on how this phase out works, plus the SALT deduction, again, going up to $40,000. Some of the taxpayers in the, $300,000 to $500,000 range before that, their SALT deduction gets phased out because your state and local taxes is not allowed for alternative minimum tax. So you may have a few more people subject to the AMT, starting next year. So something to be aware of with it. And then right in the middle of the page there, one thing that was a lot of attention, at the end of last year and earlier this year was the estate and gift exemption was scheduled to go back down to, about half of what it is now. But with this bill here, it was maintained at the higher level. They set it at $15 million next year, an index for inflation. And again, that's a permanent. So we're not going to have any scheduled drop down of the estate exemption. And again, it's going to be roughly $30 million for a married couple, again, looking to use that estate and gift exemption. So that's a significant item that many were concerned with to see what happened with that. Now, again, those were most of the individual provisions that, again, from the TCJA that were set to expire. Now we have a few new provisions I'd like to go through, and these were some items that came about from last year's political campaign that we just want to touch on here. These are no tax on tips and also no tax on overtime and a couple other ones. So next slide, please. First one, again, just want to look at, you've heard a lot about this going back to last fall and even all this year is the $25,000 for no tax on tips. Just be aware that that starts, they do have a phase out with it. If your income is too high, you're not going to get that at $300,000 for a married couple. There is a marriage penalty with that. Again, so a single person gets $25,000, a married couple gets $25,000. And the one thing that's interesting with this applies for the 2025 year. So it starts right away here with it. But again, they're going to need to have some guidance from the IRS on that pretty soon here because it already applies for this year. But this only goes through 2029. So again, this is one item again that a future Congress is going to have to deal with is to look to extend this with it. The other one is no tax on overtime. This one was also brought up in the campaign with it. And again, $25,000 for jointly. There's no marriage penalty with this one. And one thing to note with this has been some maybe confusion or people not understanding it. The amount that's not subject to tax on this is the extra amount that somebody gets for overtime. So if they get time and a half or double time for their overtime hours, it's only that excess, that half or that extra full amount of wage that they receive for working that overtime that is not subject to tax. It's not their total amount that they receive. So just be aware of that. The IRS is, I'm sure, actively working on that, provide guidance on both the tips and this overtime here. There will likely be on the W-2 form for the 2025 year, new boxes on there, a box on there for tips, a box on there for overtime, so that the individuals will be able to take this deduction because what they're going to do is include the total income you received in your W-2, you put it on your return, and then there'll be probably a new form that you do to calculate this tip deduction or the overtime deduction to subtract out how much you're allowed for that tip income or the overtime income.
Hey, Jimmy, we had a question, and I thought it would be appropriate time. No tax on overtime, is that reflected on each paycheck or is it reflected upon tax filing? Don't know about the paycheck, but we believe, and you can correct me if I'm wrong, Jim, that the tips and the overtime is going to be a deduction on the tax return. So that'll be an additional line that taxpayers will report the amount of tips or overtime. And then based on the rest of the return and some of the limitations Jim just went through, there'll be a determination as to whether all or some of that is not taxable. Is that kind of your
correct? It'll be on the individual return. So you could have 3 different employees that maybe get overtime or get some tip income. They might be affected differently depending on what else is in their return that they may have. And one thing just to note, this is not an itemized deduction, so it'll be a deduction before they get to what they call their adjusted gross income. So whether they itemize or not, they'll still be allowed those 2 deductions.
And then somebody else just asked, will W-2s have to be modified? Obviously, there's going to have, we think so, right? I mean, they're going to have to get that amount reported to you as an employee so that you can report that on your return.
Right. And for this, as I mentioned before, this applies for the 2025 years. So again, half the year has gone on before this was even passed. So they indicate that employers can use some reasonable method to gather some of those amounts for the first half of the year. It'll likely be that for some employers with these tips, that they may be capturing more tips that are going to get reported with it. Um, and again, the individuals will, have the additional income, be able to get the tip deduction, but they are going to pay some payroll taxes on those amounts that they do receive. So be mindful of that. And then employers, as you're getting this additional amount, just be mindful there is an ability to get a tax credit for those tip amounts. And those who have been taking it may have more tip income, so they may have more of a tip credit to get. So if you're an employer with it, make sure you watch for that employer tip credit, which again is a general business credit that the business or the owners of the business can take on their tax return. A couple other items that were campaign themes is there's a new deduction for seniors, those 65 and older by the end of the year, $6,000 per person or 12,000, if you're both over 65. There's a phase out with it. What Congress was unable to do is they were trying to say no tax on Social Security benefits, but based on the reconciliation rules in Congress, they weren't able to change Social Security. So what they came up with is this new senior deduction to help offset some of their income, which might include Social Security benefits, but Social Security benefits are still going to be taxable. And this new deduction starts in the 2025 year. Another one is car loan interest. They want, if you buy a car that's made in the U.S. or at least the final assemblies in the U.S., you can deduct up to $10,000 of interest on the loan for that vehicle. There's a phase out with it. Again, that starts here for the 2025 year. There's some additional reporting that's going to go on there, almost like you get on a mortgage, a 1098 type form. So we'll have to watch for that. But again, the idea with that is to encourage people, if they're going to buy a car that's assembled in the U.S., and they'll get this additional interest deduction. Again, that's not an itemized deduction. That'll be a separate deduction that they're able to claim before adjusted gross income. Okay, so moving on, Tom, why don't you move over here and we've got some new investment accounts that were also from individual provisions in the return in the bill.
Thanks, Jim. So a couple things just to remember: the SALT deduction, right, of 40,000, especially for those that live in states where maybe real estate taxes are higher on homes. I mean, it's going to put so many more taxpayers into an itemized deduction situation for 2025, which then, for those that are used to just taking a standard deduction because they didn't have enough itemized, think about, what might qualify now, and you might have to collect more information. The other thing I would say generally on what Jim covered is AMT is back a little bit, and it's going to potentially affect us. So, do some planning. So
Right.
anyway, let's go to the next slide if we could. I want to talk about the new Trump accounts. This is, I guess, an outgrowth of some ideas that have been around really a long time. One of which is called it's used in Europe and in Canada. It's called a universal savings account. And the Trump account, obviously a little bit different, but the idea is to create a savings account for kids for education, but also for some other significant expenses that will hit them in their young adult years, such as having a child, maybe starting a business, buying a home, are some of the qualified uses of that after they turn 18. But the way this is going to work is from ages 1 to 17 until you turn 18, you can contribute, parents, employers can contribute up to $5,000 per year. So the $5,000, if an employer match program is started for their employees, and they contribute, call it 2,500, then the contribution from the parents can only be 2,500. So 5,000 is both in that example. The limit is a combination of those. So, but then we also have the government pilot program, which more details to come on that, where the government's going to put in a one-time $1,000 contribution for essentially for kids that are born And we don't know if that's going to be in the form of a tax credit or whether the government's actually going to make some sort of a contribution into account. Details on that yet to come. And then there's also some provisions, which there really aren't a lot of details, where 501c3 charities can contribute to these funds. And more to come on that. But the idea is for kids that come from limited means, um, create a way for charities to support those children, create similar Trump accounts that maybe others that have them, parents, grandparents might be funding those. So there are rules around what you can invest the money in until you're 18, and very specific qualified index funds. Once you turn 18, those limitations on what you can invest it in are gone, and it functions effectively like a traditional IRA, right? After age 18, I mentioned some of the qualified uses of the funds. So if you use it for qualified uses, there won't be a penalty, and you can also, we believe, and this is a little conjecture, you could potentially convert those funds into a Roth. So this is a very interesting concept. It's new, more details to come, and we'll see how this is adopted. One of the things that we're talking about in the practitioner community is the pros and cons of this type of account versus a 529 fund versus a just a taxable brokerage account. The money coming out is taxable, except for those contributions that are made post-tax. So, it's going to be like an annuity when the money comes out. The portion of earnings or, pre-tax contributions, in other words, employee contributions, will be taxable. So a portion of it's taxable, a portion of it is not taxable. So a lot going on with the Trump accounts, and we'll look for more guidance on these. Investment incentives. So we've enhanced Code Section 1202, which is related to qualified small business stock. We're going to talk about this in the business section as well, but as an investor, if you're investing in a business or a venture capital investment, you need to know about Section 1202. What this bill did was it enhanced the provisions, it enhanced eligibility for it, reduced the holding periods from 5 years to 3 years. So prior to this bill, you had to hold the stock for 5 years, and increased the exclusion percentages. And then there's higher limitations on what is excluded, right? So this is about when you sell this stock, when you make an investment and you sell the stock, a certain portion, if not all of that capital gain could be excluded from tax if you meet all the requirements of Section 1202. So we're not going to get into all those requirements today, but you should know a little bit about this. We've got a couple more slides here. We'll go to the next slide, and I'll just cover this briefly. So the holding period changes. I mentioned from 5 years to 3 years. If you hold the stock for 3 years, you get a partial exclusion, 50%, and then it graduates up to 75 and 100%. So this is for stock acquired after July 4th, 2025. So if you do have 1202 stock today, you made an investment prior to July 4th, you have to follow the old rules. Okay. So, and then the per issue limitation, it went from 10 to 15 million. So again, that applies to stock that was acquired after July 4th. So the gain exclusion on a per issuer basis is now 15 million for all stock issued going forward that meets all the requirements. So, and then married filing separately, it's half those amounts. A couple other things here that are important and more definitional issues. They did increase the threshold of the size of companies based on this gross asset test from 50 million to 75 million. So just know that this is an opportunity as you consider some investments. And the other one we want to talk about, which is on the next slide, I think is the qualified opportunity zone. So this is something that was introduced in the Tax Cuts and Jobs Act, and it's been permanently extended. Okay, and there's been some enhancements to it. So if you invested in a qualified opportunity zone or fund, you are under the old rules still, right? It did not change, and those do not change. So at the end of 2026, the deferred gain that existed, you're going to pay tax on that under the old program. Starting in 2027, these new rules will take over. And what are the new rules? The new rules are that there's this 10-year rolling period to designate opportunity zones. So in the middle of next year, the government will come out, I think by the end of June of 2026 and establish the new opportunity zones, right? And those rules will apply for a 10-year window, which will allow investors to invest in those opportunity zones over that 10-year period. There's a couple major changes to the program. One is you still have a 5-year deferral. So you sell stock, maybe you sell part of your business, you have a capital gain, maybe you sell real estate, you have a capital gain, you want to defer that capital gain. You invest those deferred dollars into an opportunity fund or an opportunity zone, and then you can defer the gain for 5 years. Under the new rules from this bill, you pay tax after the 5-year anniversary. Okay, so you have a 5-year deferral. If you leave the money in that new investment for 5 years, you'll get a 10% basis step up. Okay, so you won't pay tax on the entire gain because that basis step up will reduce that gain. If it's invested in what's called a rural area, there's a 30% step up in basis. So the incentive to invest dollars in rural areas, right, has gone up. Okay, there's also an incentive where the substantial renovation requirements are less for investments in rural areas. So this is an attempt to move investment into rural areas to reduce the risk and provide these incentives. So think about, and we'll talk about some of the other depreciation incentives, but if you invest in a qualified opportunity zone and you can take advantage of some of the write-offs, which we'll talk about in a few minutes, Jim will talk about, you could get some tax benefit in that 5-year period before you pay tax on that capital gain. So there's some very interesting opportunities here with the pun intended opportunity zones, the new opportunity zone. So take a look at that, be familiar with that. Again, this is an area, there's a lot here. We could have several slides on this, waiting for a little more guidance, but there's a lot to talk about with this new opportunity zone, a part of the bill. All right, and I think for those of you who fell asleep, we have a poll question. Jim, do you want to go ahead and read the
first
question?
Poll question here for it. Thank you, everyone. If you would go through and do this, which OB3 individual tax provision will most impact you or your clients? The SALT deduction we talked about at $40,000, the new Trump savings accounts, or the higher gift and estate exemption. So if you could do that poll here. Okay, we'll close that in a minute here.
Numbers are forever moving, Jim.
There are. We
And
got them
that's
all set.
and not surprisingly, I think the salt deduction is going to
Salt
affect.
deduction is the leader here. The second's interesting is we get the higher estate gift exemption is second, and the new Trump savings accounts third with it. So good, that was helpful with it. Again, somewhat not surprising, but we'll see what we have. So thank you for responding to that. We've got a couple other polling questions. I'd like to move on now to go through some business provisions here. And again, that was also a major theme of the legislation here. We'll talk on some of these items here. Again, some selected topics that were important with it. Next slide, please. The first one is the qualified business income deduction, QBI, that many of you are familiar with. This came about with the TCJA, a 20% deduction. Again, that was set to expire at the end of the year. Now will be made permanent again. So that will help, past due businesses, S corporations or partnerships that have been taking advantage of this. Again, it's a non-cash deduction that they're able to. Now, there was some talk of increasing this to 23%, but that did not happen. It stayed at 20%. So just be mindful of that. Again, what this has the impact of, you're in the top tax bracket of 37%. This brings that rate down just under 30%. So again, it's a significant opportunity for past due businesses to take advantage of it. There were some changes in some of the phase outs. Not real significant, but just something to be aware that they did have a few changes with it. So those will start here for 2026 with it. But anyway, QBI is made permanent is the key one for this, just to be aware of. Next slide, accelerated depreciation. Number of businesses, again, large or small, different industries across the board. Bonus depreciation has been one that they followed. Again, the TCJA gave us the 100% bonus depreciation, but then that started to get phased out starting in 2023. Now it's going to go back to the 100% again. So just be aware of that. Again, it's for any property acquired after January 19th, which in fact would be anything acquired after, on or after Inauguration Day. One thing though is if you did have a binding contract to acquire something and it's acquired after that date, you're not going to be able to get the bonus depreciation. So that's one thing for any of your additions in the first part of the year to see when you may have ordered some equipment, major ones, you will not be entitled to that. Again, the bonus depreciation is available for new or used property that you acquire. Again, and this will be made permanent, which again, we're not going to have to worry about having this changed or cut off at some point in the future. The other one is Section 179, which again, that threshold keeps increasing. And in fact, the bill here doubled that from 1.25 million up to $2.5 million, with the phase out starting at $4 million. And again, that starts for tax years, property placed in service in tax years after 12/31/24. So on a 25 calendar year, again, you're going to have $2.5 million for the Section 179. So just be aware of these additional amounts that you're going to be able to write off, for any of the CapEx type items that you're going to have in your business. Next slide, please. Another one that's kind of a unique one is, again, sort of a theme that the administration and Congress wants is to expand and make some of this new equipment and manufacture items here in the U.S. They have this new category called qualified production property. It's a whole new statute section. What they're looking at is manufacturing, refining, and agriculture production. And what you're going to be able to do is get right up the whole facility. So in the past, if you put a manufacturing facility in, the building itself would get generally a 39-year straight life depreciation with it. If there was some equipment in there, you could get a shorter life, but the building itself would get a longer life. What this is going to do is allow you to write off that whole facility here, and the year you put it in service then. So I've got the dates on here to be mindful of. One thing they do note, though, is that any non-production, office space or some of the other space that's not used in the manufacturing directly won't get this and will have to have a 39-year life. So you're going to have to get some type of cost segregation or some report that splits out the manufacturing from the non-manufacturing with it. And they do have some other rules that we're going to have to wait for some guidance on it. But again, if you're looking to expand the business or grow it, this may be a significant opportunity for you. If you do dispose of it, though, you are going to have and change its use. You're going to have to recapture and pay back some of that depreciation that you got. So a significant opportunity available. Next one that has been a big issue, from the TCJA that really has affected a lot of businesses over the last couple of years is R&D. And this is not the R&D credit necessarily, but the R&D expense, research and development expense. And for domestic R&D, what's happened starting in 2022, instead of being able to currently expense that, what you had to do is you had to capitalize it and you wrote it off over a 5-year period. And that was a big impact on a lot of businesses that had R&D expenses, had to write those off over 5 years, really for 22, 23, and 24. And what the bill would do is allow you to go back and expense that. So anything starting in the 2025 year, or tax years after 24, you're able to go back and immediately expense that. So just be mindful of that. And again, that's only for domestic R&D. Any foreign research that you might have, it still has a 15-year write-off. So just keep that in mind. If you do have any foreign research, that has a 15-year write-off. In addition to what Congress did, just back up for that slide, is there is any previously capitalized R&D that you did have. What they're going to allow you to do is really a couple options with it. First, if you're a larger business, again, above 30 million, 31 million of gross receipts, the unamortized R&D expenses that you had in the past, you're going to be able to write those off either in 25 or spread that to 25 and 26. But if you're a small business, actually, you can elect to amend and go back to 22, 23, and 24, amend your tax returns and claim that expensing for those years. So that would be maybe an opportunity for some smaller companies to go back and amend those returns. But again, that's an elective provision, or they continue to amortize that. IRS guidance is going to be needed with that. The IRS said they hope to issue that soon to help companies make that transition, both for 25 going forward, but also for those prior year costs that they've had to capitalize and what to do with that. So something that as more comes out on that, we will let you know on that. But that's been a big issue for a lot of companies over the last couple of years. Next slide. A couple other changes that also affected business is the interest expense limitation. This came about with the TCJA. One of the things that they did with it is starting in 2023 is they changed the formula with it. They had this formula of adjusted taxable income. And it used to be we refer to as an EBITDA approach, that you take the income and you'd add back your interest, but also your depreciation and amortization, which increased that threshold and how much interest you could deduct. But starting in 2023, what it did was you didn't get to add back that depreciation amortization, made it a lower threshold, made it harder to deduct your interest. What this bill would do is change it starting for 2025. You're going to go back to the EBITDA approach again, that you're going to be able to get a higher threshold and add back your depreciation and amortization. So just be aware of that. Again, that could help out some businesses deducting some of their interest. So just be mindful of that. One thing, though, they did change, though, if you do have some foreign income, this GILTI income we'll talk about later, subpart F, that's not included in your income, so that's going to reduce it. So it's going to be a somewhat of a mitigating impact on your limitation. Next slide, please. Tom mentioned this before, this QSBS, the Section 1202 stock, and again, some of the enhancements with it. Again, that's a great opportunity for companies to be aware of. The one thing we just wanted to note with it in here is, again, this is for C corporations with it. In some cases, you may be a partnership or an S corporation and say, well, we can't take advantage of it. Well, there are some opportunities with it that you can do some restructuring and convert over to a C corp with the business to perhaps get that opportunity from this point, the point you convert going forward. So there'd be an analysis that you'd look at if you're the type of business that could do 1202 and do a restructuring to C corp to perhaps take advantage of that. So that's something to be aware of again, especially with these new limitations that are very beneficial. So we can assist with that, but that's something that some companies have explored over the last few years. And then last one, just wanted to make a note of here for you is one of the things that this bill did is to expand. There's a credit. We haven't seen too much activity with it, but with some of these enhancements, perhaps we will. For child care expense credit, goes up from $150,000 to $500,000. It's indexed for inflation after that. Again, so if an employer sets up a facility with it, they can get the credit. In some cases, if they're a small business, they can even get a higher 50% credit with it. They can even sometimes partner with other businesses to be able to get this credit. So in some cases, in some locations, and trying to get personnel, they may need to provide some childcare with it. This credit may help companies with it. So just be aware that in addition, for any employees who take advantage of the child credit, they did make some enhancements to it, both for the credit and the exclusion. Again, that starts in 2026, I believe, with it. So just be aware of that. But some companies, some mid-sized or larger companies, may want to explore this new child care credit that was in the bill. Tom, if you want to go through with our next one here.
Yeah, just a couple things on the slides on the 1202. Just in general, I think with all the changes in the tax law, I think it's an opportunity to look at the tax structure for businesses. Remember too that the asset base is 75 million to qualify for that, so it's a fairly large business. And that's the tax reported asset base with some some adjustments. So these are larger businesses that could potentially take advantage of that 1202 exemption. So that's really something to look at. And as Jim said, you could convert. So and this 45F, which is the previous slide regarding the employer tax credit, it's really an expanded credit. I think it's a recognition that childcare is a major obstacle for folks to get back to work, especially single parent families, right? I did talk to one of my construction clients, and they mentioned that, hey, construction workers, and it's not just unique to construction, but many times we have parents who need to be out in the office, out in the field, on the road before 8 a.m. and they need childcare services to be able to do that. And so what you're going to learn, I think, over time when the guidance comes out is that there are some there's really this really incentivizes employers to be creative and look at ways to try to get those benefits in place. The tax credit is significant, much more significant than it was before. And with that, we've got changes to the I'm sorry, let's go to the next slide. We got changes to the or I'm sorry. Let's go back to that slide. I think I was misreading the top of it. We got changes to the dependent care credit and increases to that, again, in recognition that child care is expensive, and the amount of child care expense that employees are incurring trying to give a tax incentive for that. So that's another significant change. But overall, we can see that this is a major issue. We know, we can read the paper. We know that this is something that, getting people back to work and full-time work, childcare is one of the things this bill is trying to address. So let's flip over a couple slides here to the next slide and talk about some of these energy credits. So remember that the energy credits, a lot of those were expanded in the Inflation Reduction Act. So just lost my lights here. The individual credits, many of the individual credits, the residential, the energy efficient credit and the residential credit on the previous slide, we're kind of flipping around here. Those are going to expire at the end of the year. So if you're thinking about windows or doors, or heat pumps, make sure that you get those investments, get those placed in service by the end of the year. The clean vehicle credit also going away in September. So some of these credits are faster, going to expire faster than what was originally anticipated. The last one there is more of a business credit, the clean energy credit for solar panels, wind power. After the end of the year, those are also gone. So, some planning here, pay attention to these dates. Let's go to the next slide. We can talk about some of these business credits. The solar investment tax credit, um, and some of the other business credits are also going away. And so again, the point is the wind production tax credit. One of the big ones is the energy efficient commercial building credit under, which is more of a deduction under 179D. That goes away middle of next year. Also the 45L, which is more of a credit for energy efficient HVAC systems that go into homes. That's also going away middle of next year. So a lot of these energy efficiency credits are scheduled to expire early. Okay, so that's going to really hit those industries hard. Okay, one of the things I did want to point out here, 45X is the code section, and it's related to advanced manufacturing tax credit. That one actually expanded a little bit and expanded. We extended some of the minerals timeline from 2031 to 2033. We've actually added metallurgical coal to that as an eligible component, so there's a credit. And interestingly, you get a credit for that regardless of if it's mined in the U.S. or internationally. So that's expanded. There are stricter domestic content rules and foreign entity restrictions. If you're doing business with certain countries that are on a list, there will be some restrictions on the use of this credit. Okay, so a couple other things we wanted to point out, industry specific, residential construction contracts, the exception to the use of the percentage completion method for home construction contracts. That definition's been expanded to residential construction contracts, so multi-unit, type structures will also get that exemption. And really, that's a deferral exemption, right? If you're building those kinds of buildings, you can defer the profit on the construction of those. Agricultural, the tax treatment of the sale of farmland. Again, probably need some more guidance on this, but if you sell farmland to a qualified farmer, you get a 4-year, in equal installments. You can pay the tax in over a 4-year period, so that eases the burden a little bit. So, and we can see that both of those are effective after July 4th. Information reporting threshold changes, 1099 miss. I think, Jim, you reported that the last time the $600 requirement change was that 1954, 63? What was the date? Do you remember?
I remember when it came out, Tom. Yeah, that was it was a
Unfortunately.
while back. It hasn't been
Yeah,
indexed, but it's good that they're
yeah,
changing it.
yeah. So
Plus,
they're
the index
indexing that. Yeah, they're indexing that up to 2000. And then 1099K has been a ongoing debate, which is payments through some of the payment services like PayPal or Venmo. You have to have more than 20,000 in payments and more than 200 transactions to meet the filing requirement on a 1099K. So that's going to really ease some administrative burden.
Yeah, good. Thanks, Tom. I think we had our next polling question coming up here now. Thank you, Tom. Polling question. Which business provision made permanent by the OB3 benefits you the most? Current expensing of research costs, we talked about the 100% bonus depreciation, or the improved deductibility of business interest expense. So if you could please indicate your response on that question here. Looks like bonus depreciation is the lead, and it's kind of split between the research cost and the deductibility of business interests. So those are kind of split between those two pretty closely. So not surprising. Again, business depreciation, 100% bonus is nice because, again, it applies across industry, small and large business. So that's a key provision. So, and being permanent will help. Okay, let's move on. Next slide here. We're going to look at just some a couple of items for some charitable contribution changes here, just to note. First, with corporations, just one thing to note here with it, and I'm not going to spend much time with it, but corporations in the past, C corporations had a 10% ceiling on how much they could take with charitable contributions. Now, what they're going to do is there's going to be a 1% floor. So they need to have 1% floor to get any deduction, and then anything above that they can deduct, but up to 10%. And if they do get at least 10%, then the 1% floor they have will carry over. So something to watch, that we've got a floor and a ceiling with charitable contributions that apply, which is new. Individuals, again, a couple things to change with it. The individuals have a floor, but it's 0.5% of their AGI. So that starts in 2026. Disallowed ones carry forward for 5 years. They do have the above the line deduction for charitables. We had a couple years ago at $2,000 for joint return, $1,000 for individuals with it. Again, not indexed for inflation. Again, that starts for 2026. So just be aware of that. And again, the high earner deductions we talked about before, with that limitation on their itemized deductions, it's going to be a 35% benefit. So it might be some things to look at. Maybe a QCD might be a way to get some benefit. Again, that starts 2026. Next slide here. Timing, when you're looking at your planning with some of these dates, take a look at some start here in 2025 with the changes. Some start in 2026. So be aware of that. Again, there might be some opportunities to kind of plan your charitable contributions when you're going to do that. Next slide here. What we do have is an example. We're not going to go through that here, but it's what they call a bunching example. And again, with the higher state and local tax up to $40,000 and you're charitable, what some may do is take 2 years of deductions and put them into one, and then in that subsequent year, just take the standard deduction. So you still spend the same amount of money, but you just time when you incur those, and you may get a benefit here. We all have an example that we looked through that you can look at. They actually get an extra almost $30,000 of deduction just by when they timed it without spending anything more. So you can read the example here, next page. But again, the key with it is the same overall amount spent, but just based on the timing of when you incur your taxes and your charitable, you may get a benefit. And I think there'll be more activity with it. And the last thing just to mention on charitables here quickly is this SGO. It's a new tax credit that's available. Many states have had that for a number of years. It's up to, you get 100% deduction, but it's up to $1,700 per taxpayer annually. I think if it's a joint return, you might get $3,400, but we'll need to get some guidance from the IRS on it. If you exceed that, you get a carryover. But if you get a state credit with it, you can't double up with it. So you've got to reduce it for any state credit you have. So something that's new that some states have had, we'll wait for some guidance on that, but something to be aware of for some charitable. Next slide here, Tom.
Yeah, we'll cover this real quick and take note of the charitable changes. I mean, take a look at those, because the above the line deduction, in other words, if you don't itemize, is higher. But large endowments, we've seen this already, but to change some rules. So there's some excise tax on a sort of this new tiered structure. There's a new calculation for what on a per student basis, the size of the endowment. So we'll see that effect. One of the things to note is I think the enrollment threshold is you have to have enrollment of at least 3,000 kids in order for this structure to. So smaller schools that may have big endowments will be exempted from that. And so here's just some more information. Minimum enrollment threshold I mentioned. There's a lot here. We'll jump into the international provisions real quick, Jimmy.
Yeah, international ones, just to highlight here with it. Again, TCJA had a lot of changes with it. They had some follow-up ones with the bill that just passed here. Maybe not as comprehensive, but still some things to be aware of with it. Some had some revised calculations, some were renamed. The first one here, just to mention, both the FDII and the GILTI, both were changed and recalculated. So be aware of that if you have any companies that were going through. Next slide, please.
Hey, Jim, I think we're going to launch the last poll for those that are on a time crunch, and then we can kind of go
Okay,
back and finish the slides up. So if we want to jump ahead to that last poll,
sure.
for those of you who are on a pretty tight calendar here, maybe we can launch that real quick, and then we can cover the last, I think we have about 5
What
slides.
impact of the business provision impacts you? The qualified production property, again, the 100% write-off, the enhanced employer-provided child credit, or the new 1202 QSBS stock. So if you could answer that one here, thank you. Interesting
Yeah, a lot of
with the
kind of
activity with it.
um,
Qualified production is in the lead, but we're also getting some of that enhanced employer-provided childcare pretty close with the 1202 stock. So, okay,
yeah, those are some interesting new developments, frankly, and I think we should
right.
study those. All right, thank you. Let's jump back to the rest of these couple more
International
slides.
ones again. Next slide, please. Just to point out that there are changes with the next slide. With the FDII deduction now is changed to the FDDEI, which is the foreign derived deduction eligible income. And again, they changed the calculation slightly with it and also made some adjustments with the research and interest costs and how it's calculated. So be aware of that if you've got this FDII deduction. Next slide, please. The GILTI is also changed now. It's got a whole new format. It's changed to the net CFC tested income, or NCTI. Again, some revisions in how that's calculated, so be aware of that if you've got that. And the last one is if you do have any foreign source income that you make the product here and you ship it overseas. Next slide, please. You're able to get some more foreign source income, which help you use some foreign tax credits. So just be aware of some of those changes if you do have that. I think we're set with it. Just some final takeaways, Tom, that
Yeah.
you can go through that just be aware of.
Yes. So, pay attention to the effective dates of some of these things and look for more guidance. What I will end with is we've got a lot of questions we didn't cover. There's a lot of questions on the overtime pay. Does it apply to unions? How does it apply? We noted that in the pre-webinar questions. So we will provide some probably FAQ document to this group and to those who weren't able to attend also on some of those questions. I can tell you we may not know the answer to some of them just because of the lack of guidance, but we will cover all of those and understandably because some of those provisions apply to 2025, there's a lot of interest in implementation and how to implement these things. So, pay attention to the dates, pay attention to what is and isn't permanent, and we'll make sure we focus some of our future content, whether it's an article or a webinar, on some of these specific issues. But look for more guidance from us and from others as it becomes available to try to implement some of these laws. So I want to thank everybody today for coming.
Thank you.
As I mentioned earlier, there will be a survey at the end, so please take that. Certificates will be sent via email within 7 days. And today's webinar was recorded and will be available for on-demand access. And again, thank you very much on behalf of Sikich, and thanks, Jim, for the great presentation.
Thanks, Tom. Thank you, everyone. Have a great day. Thank you.